Okay, hello again. So today what we're going to do is we're going to go ahead and go over chapter one. So chapter one is dealing with costs and looking at the different types of costs in accounting and managerial accounting and how do we work with those. The main deals with how managers need to rely on different cost classifications for different purposes. The main purposes emphasized in this chapter include assigning costs to cost objects, accounting for costs in manufacturing companies, preparing financial statements, predicting cost behavior in response to changes in activity, and in making decisions. So let me go ahead this up and then I'll share the screen with you. So chapter one, managerial accounting and cost concepts. So first of all, we need to understand, what we're doing and the needs of management in terms of classifications for assigning costs to cost objects. And in financial accounting, we know that we're concerned with financial reporting financial information to external parties, such as stockholders, creditors, and regulators. And we know that from when we took accounting 4A, that there were specific requirements of how things have to be laid out, and that's because that's how these external users are expecting things to be. But for our purposes in managerial accounting, we are concerned with providing information to employees, to other managers within the organization, internal, in order to help them to be able to formulate plans, to control their operations, and to make decisions. And so again, we see here some of the purposes of cost classification. And we'll go into some more detail here shortly. But again, what we need to know how to do is to assign costs to cost objects. We need to account for costs in manufacturing companies. This is what we're going to be looking at. Preparing financial statements, predicting cost behavior in response to changes in activity, and making decisions. So for our first section, we're looking at first of all, a cost object. A cost object is anything for which cost data are desired, including products, customers, jobs, organizational subunits, etc. Jobs, for purposes of assigning costs to cost objects, costs are classified in two ways, and we'll look at what those are. But again, just knowing that in business, we want to assign costs to various activities within the business. And again, we see the different areas, dealing with products, dealing with customers. It may be a specific job that we're doing. It might be within a particular part of the organization, but we have direct costs and we have indirect costs. And this is an important concept for us. So direct costs are costs that can be easily and conveniently traced to a specific cost object. An example that we're going to see might be direct materials or direct labor. We know directly what materials are going into a certain product or into providing a certain service, and of course, the labor that goes into building that particular product or that service. Now, there are also indirect costs. Those are costs that cannot be easily and conveniently traced to a product or a unit of product or another cost object. So an example might be manufacturing overhead. So you have manufacturing overhead for, let's say, rent on a or lease on a manufacturing building, or the overhead that goes in with the upkeep on machinery. You're not able to allocate that specifically to each unit. So those would be an indirect cost. Now, we also have common costs, which are indirect costs that are incurred into support a number of cost objects. These costs cannot be traced to any individual cost object. And so again, things like rent, utilities, and so on and so forth. And we'll look some more at that. And what we're looking at now is that manufacturing companies, they separate their costs also further into two different categories. So they have direct and indirect costs. They also, if it's a manufacturing facility, they also would break it down in terms of the costs that are manufacturing costs and in those costs that are non-manufacturing costs. So for example, this cost for the CEO, that would be a non-manufacturing cost, but anything specifically going into the manufacture of a specific product would be a manufacturing cost. Okay, so we have direct materials, direct labor, and manufacturing overhead. And we're going to go into now what each of these um, areas are. So direct materials are the raw materials that become an integral part of the finished product and whose costs can be conveniently traced to it. And I'll kind of, since, well, here I have I don't know, I'll use this. So I'll kind of hold up here, I'll hold up my phone, my Apple iPhone. So the direct materials, what kind of direct materials would go into building an iPhone, right? You have the, I don't know, whatever aluminum or whatever this back of the phone is. I know I have a case on it, but the back of the phone, these little cameras, that's something Apple didn't make them, but they had to purchase them from somewhere. The screen, the circuit board that's inside here, the battery, all of those things would be direct materials. If it is something like, I'll use this, so I don't want to use the other thing that's sitting here. I don't want to use the Mountain Dew. The missus, she's a big Mountain Dew fan. But I have a can here of a Polar seltzer, and I'm just holding my hand just so that it doesn't blur out. So what kind of materials, direct materials would go into making a can? Who makes this junk? I drink it. Oh, Polar, under the authority of Polar. But I think Pepsi, I think it's a Pepsi product, I think. Because they have a deal at Save Mart, buy three, get two free or whatever on the 12 packs. And so I think that's why I bought this so I bought one for me. But what are the direct materials? Obviously, the can is a direct material, but what all would be a direct material of this, right? Okay, carbon. So what this is carbonated water. So the water is a material, which that really wouldn't be, I guess, but it's needed. The CO2 for the carbonation is a direct material, and the whatever the natural flavors. This one is strawberry and watermelon. So the strawberry and watermelon flavor would be an example. Okay. So those would all be direct materials. Now, the direct labor then is the labor costs that can be easily traced to individual units of product, which could be, they say, sometimes called touch labor. So direct labor, that's whatever goes into actually making the product. So for example, somebody that works in the factory, in the Foxconn factory for Apple, and they run the pick and place machine that puts all the little capacitors and all the little chips and all the little diodes and whatever on the main circuit board of this. Well, that's direct labor, somebody that's running a factory. Or you have somebody that is working a machine that's putting this together, right? So that would be direct labor. Same thing with the cans. Somebody that's putting all the cans on the line, somebody that's putting all of the ingredients together, and so on and so forth. Okay. And then we have manufacturing overhead. Okay. And they have some examples here, and then I'll go into some more. So manufacturing overhead includes all of the manufacturing costs that are all of the costs except our direct materials and direct labor. And these costs cannot be readily traced to finished products, also called indirect manufacturing cost, factory overhead, or factory burden. Those are all other names that you might hear this. And I'll touch some more on this in a minute. So again, direct materials. again, those are the raw materials that go in it. An example might be a seat that's being installed in an airplane, or like I said, the can or what have you. Direct labor would be, again, the direct labor costs for those parts being put into um, actually put those things together. So example, somebody that works, let's say, at the Ford factory, and they're building, I don't know, Ford Fiestas, which they don't even make anymore, which is just a small little four-door sedan or hatchback. So somebody that's working in the factory actually putting those together would be direct labor. Now, manufacturing overhead, as we said, is everything else that's not our materials and our labor. So it might include indirect materials that cannot be easily traced or uh, conveniently to go into each individual product. So for an example, like with my little can here, I'm not going to trace, for example, these cans, they're printed. I'm not going to be able to trace like how much ink is used on this. Or, I mean, I know how much flavor's in it, but I'm not going to be able to trace like, I don't know, that's kind of a silly example. But like, for example, let's say that it's an automotive facility and I'm building cars and I have to put on some of my bolts, I have to put Loctite on some of my bolts so they don't come out. I'm not going to track exactly like, okay, I used 4 little dots of Loctite on this car. I can't. I'm not going to do that. So that would be an indirect material. Okay. I know in another book that I used, they talked about people that did picture frames, and you have to do staples. That's an indirect material. Okay. So you're not going to be able to trace it to a specific product. Another one might be indirect labor, which again is for labor that you can't necessarily count specifically to specific units. So that might be labor specific for like the production supervisor. Okay, labor. That's, you don't know how much of his labor actually went into making it. Another example of manufacturing overhead might be our depreciation on our manufacturing equipment. Obviously, we know from before that's an expense, but we don't know how much of that goes into each product. Utilities, again, to count. So, for example, with the polar water, it takes water to do that. Well, you have to have a water bill, and obviously you need water for everything else in the facility. But you're not going to be able to track, okay, how much of that goes into that, or lights, or heat, all those kinds of things. Property taxes would be another one. And then insurance premiums that incurred in operating a factory. Again, you're not going to be able to segregate that out. So only those costs that are directly associated with, or they're associated with operating a factory, would be considered manufacturing overhead. So you have overhead that also deals with the whole organization. So you have like the sales force, you have all of that. We're not talking about that here. That wouldn't be part of manufacturing overhead. It has to be involved with the actual factory itself. Okay. Okay, so we have prime costs, which are our direct materials and our direct labor. Those are considered prime costs. And then we have conversion costs, which is our direct labor and our manufacturing overhead. So that's kind of a definition kind of thing. Keep that in the back of your mind. So again, prime costs are direct materials and direct labor. Conversion costs are direct labor and manufacturing overhead. And keep that in mind as we work through this. Now, we also have other costs that we would be concerned about as well. So we'll have selling costs. Those are costs that are necessary to secure the order and also to deliver the product. And selling costs are neither direct or indirect costs because they are not dealing with manufacturing. They're overhead for the entire business. So to be S&A, sales and administration costs. And then administrative costs are for all executive, organizational, and clerical costs. Administrative costs, again, are neither, well, they can be either direct or indirect. Yeah, selling costs can be either direct or indirect, but they're not involved with specifically with the manufacturing. So it's part of our overhead costs. All right. Product costs include all costs involved in acquiring and making a product. Product costs attach to a unit of the product as it is purchased or manufactured, and they remain attached to each unit of product as long as it remains in inventory awaiting for sale. So anything involved with acquiring and making a product. And so some of the product costs would include raw materials, which again are the materials that go into making the final product, or work in progress, which are units of product that are only partially complete, and it will require further work before they can be completed and ready for customers. And then finished goods, which consist of completed units of product that have not yet been sold to customers. And okay, the other thing we have to do is we also have to transfer of product costs. So when a direct materials are used in production, their costs get transferred from the raw materials inventory to a work in progress inventory. So when something comes in as raw materials, it's going to be in one area. Then once we go to use it, we're going to have to transfer that cost over into that other department. Okay. Direct labor and manufacturing overhead costs are added to work in progress to convert the direct materials into the finished product. So we also have to account for our direct labor and our manufacturing overhead costs get added into our work in progress to be able to keep track of that. Now, once units of product are completed, their costs get transferred from the work in progress to the finished goods. And then when a manufacturer sells its finished goods to a customer, the cost then gets transferred from our finished goods inventory then into our cost of goods sold to recognize it. Okay. And so we kind of see here how that's going to go into our T accounts and into our different areas. So we see that our product costs include our direct materials, direct labor, and manufacturing inventory. And so upon a sale, our inventory then is going to go from our balance sheet inventory account into our cost of goods sold account, which is going to then affect our income statement. And then period costs, which are all of our selling and administrative costs that we talked about. So anything not specific about manufacturing the product, so all the other overhead then are expenses and they'll get listed to the income statement. So a quick check. Okay. So which of the following costs are would be considered a period rather than product costs? So one might be probably the property taxes would be one, right? Our property taxes are a period cost. Sales commissions are a period cost. Everything else would be considered something else. All right. So cost classifications for predicting cost behavior. So there's different types of costs that we are going to look at. So we have variable costs, fixed costs, and then we also have, sometimes we'll see mixed costs. So a variable cost is a cost that varies in total in direct proportion to changes in level of activity. And so a variable cost per unit is constant. So it's going to be the same per unit, but you multiply by how many units, and then the total is going to change. And one of the things to be aware of is you have to have an activity base, which would be a cost driver. And some of these might be, and again, this is a measure of what is going to be a measure of what's going to be the influence in your variable cost. So you might have, it might be based upon the number of units that are produced, the number of units that are sold. It could be the number of machine hours or the number of direct labor hours. Those are what we're going to base it on. And so it's going to be, the total is going to be different based upon, you're going to have a set amount, which is the per unit variable cost. You're going to multiply that by the cost driver. We'll see that in a minute. Then you might have fixed costs. Fixed costs are costs that remain consistent in total, regardless of changes in the level of activity. If expressed on a per cost basis, the average fixed cost per unit varies inversely with changes in activity. So what this means is a fixed cost, and there's different types of fixed costs, but this cost, it's going to remain the same regardless of the level of activity. And if you were going to divide it out based on how many units you have or whatever the activity base is, it would actually be the more units there are or the higher the activity, the less it's going to be per unit. Okay. So examples of fixed costs are going to be committed, which are long-term costs. They cannot be significantly reduced in the short term. Then we have discretionary fixed costs. Those are costs that may be altered in the short term by current managerial accounting decisions. Okay. So one way that we can, let me go back. So one way that we can think of this is if you think about the cost, for example, a large pizza. So what would be the cost per student if two students buy pizza? Let's say that the pizza, it costs $15 for a pizza. Okay, but if you're doing that then for each student, let's say two students go in and they're going to share a pizza. So each student would have to put in $5, right? Or no, it'd be a little bit more. But say it was $10 a pizza. If two students share, it'd be $5, right? So on and so forth. Now that makes it clear why the average fixed cost changes on a per unit basis. Because again, the fixed cost stays the same, but if you divide it out over more units, it's going to be less. Okay. But for example, let's say that somebody there, you go into a restaurant and you order pizza, and the total beverage bill was $2. So two people are eating, so it's $1 a beverage. Or if you have four people eating, it's $4, so $1 a piece. The cost per beverage remains the same, but the total would change based upon the number, and that would be an example of a variable cost. All right. So the linearity assumption and relevant range, and this is an important concept to understand. So accountants usually assume that costs are strictly linear. However, economists point out that many costs are they're not actually linear, they're curvilinear. So nonetheless, within a narrow band of activity known as the relevant range, a curvilinear cost can be satisfactorily approximated by a straight line. And that's a whole lot to say, and we'll hopefully come up with a better example here. But that's a whole lot to say that your fixed costs, they're going to be the same within a certain range of activity. So once you hit a different range of activity, then it might, depending on what it is, make that fixed cost jump, depending on what it is. So for example, let's say that you're a manufacturing facility and you have the salary for a supervisor, production supervisor. And that supervisor, he's going to work an 8-12-hour shift, okay, a day. Okay, so that's what he can do. So if you're only running one shift, within that range, you're able to, that's going to stay the same. But let's say that you need to run another shift, then you're going to have to, it outside of that relevant range, it is going to make that fixed cost go up because you're now having to hire another supervisor, production supervisor, in order to do that, take over that other shift. So within a certain range, it's going to be constant. But once you get outside of that, then that's where it's going to be. Or let's say that you have a production line and you're capable of making so many units, but if you need to make more than that, you're going to have to bring on another piece of equipment and you don't have it. So if there's fixed costs associated with that, then after you get beyond that, it's going to be more. So let's look at another example. So again, the relevant range of the activity pertains to the fixed cost as well as the variable cost, and that also is affected. So for example, assume office space is available at a rental rate of $30,000 per year in increments of 1,000 square feet. So 1,000 square foot building is going to be 30,000 per year. So the fixed cost would increase in a step fashion for each additional 1,000 square feet. So if we have, maybe it's one building, but there's multiple portions to it, each 1,000 square feet. If you want another portion of that building, another 1,000 square feet of that building, you're going to have to pay another 30,000. So once you get outside that relevant range, it's going to be more. And we see here how, so it'd be 30,000 for 1,000 square feet, 60,000 for 2,000 square feet, 90,000 for 3,000 square feet, and so on and so forth. So once you get beyond that relevant range. Okay. So again, the relevant range for a fixed cost is the range of activity over which the graph of the cost is flat. And it is helpful to think of variable and fixed cost behavior in a 2x2 matrix. So kind of to summarize this is if we look at this and we say, okay, variable costs in total are going to increase and decrease in proportion to changes in activity level. So our variable costs will. And then per unit, the variable cost will remain the same. But our fixed cost are not going to be affected by changes of activity level within a specific relevant range. Now, as I say, once you go outside of that, then it's going to be different. And then our fixed cost per unit would decrease when activity rises and would decrease when activity rises and would increase when activity level falls. So let's do another quick check. So which of the following costs would be variable with respect to the number of ice cream cones sold by Baskin and Robbins shop? So would cost of lighting for the store, would that change based on the number of ice cream cones? No. The wages for the store manager, would that change, do you think, for the number of ice cream cones that were sold? No. The store manager, they're on a salary basis, so they're there to work, Monday through Saturday, or whatever, 40 hours a week or whatever, or that's what they work, 40 hours a week. It's not going to change. They're on a salary. Now the cost of the ice cream, that would probably change, right? Because if we're selling more ice cream cones, then we're having to use more ice cream, right? Also, the cost of the napkins. Obviously, if we're again having more sales, we're going to use more napkins. So those would be C and D would be costs that would be variable based on the number of ice cream cones that were sold. All right, mixed costs. So a mixed cost is a cost that contains both variable and fixed elements. And so an example of this, and I can give you a real world example, might be a utility bill. And so, for example, and our PG&E bill works this way. Um, you have a fixed monthly charge that's charged no matter what, no matter how many kilowatt hours you use of electricity, right? So, for example, let's say somebody has solar on their house. So they're not, and they have, the Tesla Powerwall. So at night when there's no sun out, and if they're like me, and even if they have an electric stove, obviously they have electric lights, everything else, they're cooking dinner on an electric stove, but it's pulling electricity from their Tesla Powerwall, which is battery storage. So we're not using any of PG&E's electricity. During the day, if I'm home while it's light and I'm using things during the daytime, I'm using the solar energy. At night, I'm using the solar backup, right? I'm using the batteries. So if I'm not pulling anything from the grid at all, I still have a fixed monthly charge. It's $15 or whatever they charge. I don't know what they charge. Okay. Another example, then you have a variable cost for example, for kilowatt, right? So you might have, um, so you have for each kilowatt you use. So let's say you decided in the evening you're going to run the air conditioning and you now used all the electricity, you cooked dinner, maybe you baked I don't know, you baked a tri-tip in your oven. And so it's like my oven, it's an electric oven. And so you used your energy in your Tesla Powerwall for that. And you also needed to turn on the air conditioner because you just used your oven and it's hot. You're pulling from PG&E, so you're going to have a cost per kilowatt hour. And that's going to be variable based upon how much you're using. And then they also charge based upon if you go over a certain amount, a certain relevant range, guess what? They charge you more. You go into a higher tier, they charge more per kilowatt. Where I live, because unfortunately I live in the county of Merced, we have what they call a water district. Our water bill now works like this. It used to not work like this, and they recently changed it. So I have a fixed monthly charge no matter what, how much, if I don't, let's say I go away for the month and I'm not bathing in the house, I'm not doing laundry, I'm not doing dishes, I'm not doing anything in the house, I'm not watering outside, I'm not doing anything that uses water. So I'm not using water at all because I'm gone. I'm gone for the month and I'm gone that entire billing period. I'm still going to get charged. I think it's 11.99 or something like that. That's just for them having a water connection. That's a fixed monthly charge just for having the water connection. And then they charge me based upon how many, and they measure it in what is called cubic feet. So how many cubic feet of water? And obviously that changes from time to time based upon, obviously what I'm doing. If I'm watering the lawn more, it's a summer, I'm watering the lawn more, obviously I'm using more water. If something happens and I get a bunch of clothes or and I need to do more laundry more that month, then I'm using more water. Okay. So those are all things. So and they charge per, and that's the variable charges for however much cubic feet of water I'm using, they're charging more. So one month my bill, the total bill might be $68. The next month it might be 70, it might be 72, 73. It might vary a little bit based upon how much water I'm using. So that would be a mixed cost, one that has a fixed component and one that has a variable component. Another example that you might see. Okay, okay, and so they give us the math, and they give us the slope formula there. You get to do some algebra. But for example, here they're talking about the example I gave with a utility bill. Another example you might see is you might see is like, let's say you have a company and maybe you lease a photocopying machine, and they might say, okay, it is $100 a month to lease that machine. So just to have it in your place, it's $100 a month. And then they might charge, 2 cents a copy. And that 2 cents goes to pay for the toner, any parts, anything, service, all of that. But based upon how many copies you make, if you 1 month you make 10,000 copies in that month, it's going to be more than, let's say, there's 1 month and you only had to make 5 copies. It's so it's a mixed where you have a fixed portion, you also have a variable portion. Okay, so costs and how this works for decision making. So decisions that involve so we'll talk about how do you make a decision if it involves choosing between two different alternatives. So the goal of making decisions is to identify those costs that would have either a relevant or that would be irrelevant to the decision. So to make decisions, it is essential to have a grasp on the concept of differential cost and revenue, opportunity costs, and sunk costs. And we'll go into what each one of these is, because there are certain costs. If you're thinking about doing something, realize that there are things that are relevant to your decision. There's things that are not relevant to your decision. And I like the other textbook that I used. I like the OpenStack book a little bit better because they use an example. Let's say you were going on a trip, kind of give you an example of that. First of all, okay, well, I'll leave it here and I'll kind of give an example. So let's say that you were going to plan a trip with your friends. There might be, now there's relevant costs and then there's relevant, and then there's costs that are irrelevant. So for example, let's say that your friends, they're going to pay for their own meals. So if they're going to pay for their own meals, then you're not worried about that. It's an irrelevant cost. You're not going to look at that. You're just worried about your own meals and where you're going to go. If you were going to take, let's say, your car only seats 5 people, if you're going to take a sixth person, you and 5 friends, then you're going to have another vehicle. So you're trying to figure that out. If everybody's going to pay their meals, that's an irrelevant cost. But if you think, okay, well, I'm going to have to pay to rent another car, that would be a relevant cost, because if I'm going over that. And again, within a certain relevant range, within 5 people, the driver and 4 people, you're good. But once you go over that, then it becomes an issue. Okay, so there's different things here. So I know the other book I know talked about that, but we're not using that. But an example, so we have differential or incremental costs. So a difference in revenue between two alternatives is called differential revenue. So if we're going to make a decision that's going to affect our revenue, then be differential revenue. Both are always relevant to the decision. So our differential costs or our revenue, both are going to be important to our decision process. Okay, so differential costs are the difference between the cost between two alternatives, a difference in revenue between two alternatives, difference revenue, and we are going to have to look at that. And then differential costs can be both variable and fixed. Now, oh, did I miss a? Okay, so opportunity cost. So an opportunity cost is the potential benefit that is given up when one alternative is selected over another. These costs are usually not found in accounting records, but must be explicitly considered in each decision. And so let's say that and I'll go over the example there, what they say there, but let's say that you were going to purchase gold for $400 an ounce, but it's now selling for $250 an ounce. Should you wait for gold to reach 400 an ounce to sell it? Oh, wait, that's an example for sunk costs. So we'll go into that. But what would be some opportunity costs for you attending class? For you deciding to go to college, or for you deciding to take this time right now to do your schoolwork, since this is for an online course. Well, the opportunity cost of you attending school, maybe you're not able to work because you're using your time to go to school, right? So that would be an opportunity cost, right? So you're not able to work, or maybe work as much because you're going to school, right? Or maybe you want to go and play football or basketball right now, but you're having to sit down and do your schoolwork. So that would be an opportunity cost. What are you giving up to do a certain thing? So sunk costs are costs that have already been incurred and they can't be changed now in the future. And so they would be irrelevant. And the example that I read to you would be, these costs are usually not found in accounting records, but they would be considered also. So again, if you already purchased gold for 400 and it's now only selling for 250, should you wait for it to get back up to 400 before you sold it? Many students would say yes, even though the $400 purchase is a sunk cost, because you've already purchased it. So it's really irrelevant to the decision. But okay, it's 400. I paid 400. I probably don't want to sell it for less than that. So that's something to consider. But it's a cost that's already been incurred. So let's say you already paid your tuition for the class. So you've already paid it. So then you might as well continue to take the class because you've already paid it. All right, let's look at another example. Suppose that you've decided that you want to drive, you're deciding whether you should drive or you should take the train to Portland, Oregon in order to attend a concert. And you have ample cash to do either, but you don't want to waste money needlessly. So is the cost of the train ticket, would that be relevant to your decision? In other words, should the cost of the train ticket affect the decision if you should drive or take the train to Portland? Yes. Yes. So you are going to have to consider that, the cost of the train ticket, and that might be your deciding factors once you figure out, okay, the cost of gas, the cost of everything else. If it's going to be cheaper to take the train, then you would decide to take the train. There might be other factors that you're going to consider, and they don't really talk about this here. But there might be other factors maybe that aren't financial factors to decide if you're going to drive or take the train. One might be time. If you drive, you might be able to get there quicker than you can taking the train, because the train has to stop in every little town to either drop off or pick up. Whereas if you drive, you could just drive straight through. Obviously, you have to stop for fuel or to recharge, or you have to stop, obviously, to use the bathroom, and food, and that kind of a thing. Or if there's any place along the line you want to stop at too, but it would be faster. Another one might be comfort level. It's a lot more comfortable to take the train usually than it is to drive. And then fatigue. It's a lot less fatiguing to take the train than it is to drive. So there's non-financial decision areas also that you might consider as well. But we're just focusing here on just the financial factors. Now let's look at another one. So again, you're looking at this if you're going to drive or take the train to go to Portland, and you're trying to figure out, is the annual cost of licensing your car relevant to this decision? So the car registration, is that something that is that relevant to whether you do it? And it wouldn't be. because you've already paid that. You already have to pay the card registration, whether or not you use your car to go on that trip or not, you still have to pay it. So it would not be relevant to this particular decision. Now, suppose that your car could be sold now for $5,000. Is that a sunk cost or not? And it's not a sunk cost because that's what you could get. That would be considered, I guess, an opportunity cost of either keeping the car now or what you could get for it if you were to sell it. Okay, so now looking at the different types of income statements. So we have the traditional format, which is used primarily for external reporting. And we also have the contribution format, which is used for, which would be used internally by management. And we see here that they show pretty much the same information in terms that the bottom line is the same. The net income or profit is going to be show the same regardless. Your income is going to show the same regardless. What is different is how your costs are broken down. And you wouldn't necessarily want to give that kind of detail to somebody outside the organization. So that's why you'd use the traditional format, external, the contribution format, internal. But the contribution format is both of them. You need both of them. You will see both of them and use both of them. But the contribution format is one that as a manager you will pay more attention to. But how we can use, oh, let me go back. So again, what happens is the contribution approach separates costs into there, as we see there, the fixed and variable components. So sales minus the variable costs get us what is called our contribution margin. So that tells us how much that is contributing to our bottom line. And then we have the contribution margin minus our fixed expenses then would get us our net operating income. And this contribution income statement tool is used as an internal planning and a decision-making tool. And you can use it to do cost volume profit analysis. You can use it to segmented reporting of profit data. You can use it for budgeting purposes. You can also use it to make special decisions such as pricing or if you should make a certain item or if you should buy it. And we'll learn about all of those things, and we see here which chapter they pop up in. We'll learn about it there. One thing to realize is that if you were to look at, okay, they're just saying that if you were to look at an income statement for a well-known local manufacturing firm to illustrate functional income statement. Okay, so there's different categories in that, and I'm not going to go into that. But just know that you can use this in order to figure out, like if your sales were going to increase, you can figure out then how much your variable expenses would increase. And then that would allow you then to work with it and kind of do some different types of forecasting. So the contributions format, that is very useful to you. And so as a manager, that's going to be the one that you're going to primarily focus on. So go ahead now and complete your discussion as well as your other activities for this week. So bye for now.